Hey guys, my name is Evan and welcome to Economics 101, your number one source for everything econ. So, inflation just delivered a major surprise. The June 2026 PPI report is out, and the headline numbers were not what many economists were expecting. PPI producer prices actually declined, signaling that inflation pressures at the business level may be cooling off a little bit. The big question, though, is this the beginning of a real inflation slowdown, or is it just temporary drop caused by falling energy prices? Because the answer could impact everything from Federal Reserve policies to stock markets, interest rates, and even what consumers pay for everyday goods. The Bureau of Labor Statistics reported that the final demand PPI fell 0.3% in June, while producer prices were still up 5.5% compared with a year earlier. So today we're going to break down what the June 2026 PPI report actually showed, the biggest drivers behind the inflation moving lower, including energy, goods, and service prices, and what this means going forward for the Federal Reserve, financial markets, and the impact on everyday consumers like me and you. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy economic breakdowns that simplify complicated financial news, please take a second, hit the like button, subscribe. It helps more people find the channel and allows me to continue creating these inflation fed and market analysis videos every week. So let's go ahead and break down the numbers. Well, the headline number immediately grabs attention. Producer Price Index, PPI, measures prices businesses receive for goods and services they produce. Think of it as inflation earlier in the supply chain before prices potentially reach consumers. For June 2026, the final demand producer prices dropped 0.3% month over month. That followed a 0.6% increase in May, making June's decline a significant reversal. So, why does any of this matter? It's because producer prices often provide clues about where consumer inflation could move next. If companies are paying less for inputs, transportation, and materials, they may have less pressure to raise prices for customers. But the important detail is the headline number doesn't tell the entire story. The reason prices fell matters. And that brings us to the biggest driver behind this report. The biggest factor was energy. We know it's energy. We know that crude gas prices have been coming down, and according to the report, the final demand good prices declined 1.4% largely because of energy prices. Energy prices fell 6.4% during the month. Gasoline prices were one of the major contributors, falling significantly. This creates an important economic question. Is inflation cooling because businesses are becoming more efficient, or is inflation cooling because one volatile category, energy in this particular topic, moved lower? Energy is important because it affects almost pretty much everything. Lower fuel prices is going to reduce transportation costs, it's going to reduce shipping, manufacturing, businesses operating expenses. And eventually, those changes can influence consumer. However, energy prices can move quickly in both directions. A geopolitical event, supply disruptions, or oil market shock can reverse those gains. So while this report is positive, economists are still watching whether inflation is slowing across the broader economy. And that leads us to the next major piece of the puzzle: goods versus services. The inflation story is not just about one particular number, it's about where inflation is coming from. In June, good prices helped pull inflation lower, but services moved the opposite direction. Final demand services prices increased 0.2% in June. This mattered because services inflation has historically been harder to bring down. Services include areas like your healthcare, professional services, transportation, housing intensive industries. Businesses in these sectors are often more affected by and labor costs. So even if goods inflation improves, the Federal Reserve still needs confidence that service inflation is also moving towards its target. This creates the bigger economic debate. Are we seeing a broad inflation slowdown across many industries, or are we just seeing cheaper energy temporarily lowering the headline numbers? Now, the next question everybody wants answered is, what does this mean for the Federal Reserve? So the Fed's biggest challenge has been balancing two risks. We talk about this in previous videos, But risk number one is keeping interest rates too high, too long could slow economic growth. All right. Risk number two, cutting rates too quickly could allow inflation to return. This PPI report gives policymakers another reason to believe inflation pressures may be cooling off, maybe easing a little bit. A softer producer inflation report, it can support the argument for eventually cutting interest rates. But the Fed is not going to make decisions based on one report. Officials Officials will continue watching the CPI inflation. They'll watch markets, wage growth, consumer spending. The key from this report is not that inflation is gone or inflation is moving down. The message is that inflation pressure may be in the right direction. Okay, and that brings us to the final. What does this mean for markets and consumers? When inflation data comes in cooler than expected, markets often react because investors immediately think about interest rates. Interest rates are a huge part of our economy, and low inflation can create expectations for lower borrowing cost, more supportive monetary policy because the report some inflation concerns. For consumers, the impact is more complicated. A lower PPI does not mean prices immediately fall at the store. Okay. Instead, it means businesses may face less pressure to increase going forward. The areas consumers should watch for include like your mortgage rates, your auto loans, your food prices. The takeaway is that inflation is cooling, but the path is not guaranteed. Energy helped create a better inflation headline, but services and global risk remain important. Guys, we have a quick pause. If you want more breakdowns like this, please make sure you're subscribed to Economics 101. This channel focuses on making economics, inflation, markets, Federal Reserve decisions. We make it easier to understand without complicated financial language. If you find this video valuable, hit the like button because it helps the channel reach more people who want to understand what is happening in the economy. Now let's finish by looking at the bigger picture. Okay, so what does this? So what does the June 2026 PPI news is that producer inflation moved lower. Energy prices produce major relief. Businesses are seeing less overall price pressures, but the story is not finished. The Federal Reserve has to determine whether inflation is truly on a stable path downward. The next few inflation reports, labor market updates, and economic data releases will help determine what happens next in the market or what happens next with interest rates and the markets. Now I want to hear from you. Do you think PPI report means inflation is finally under control, or do you think inflation risk could return? Let me know your thoughts in the comments. If you enjoyed this breakdown, make sure to hit the like button, subscribe to the channel, and turn on your notifications for more economic analysis. Here on the Economics 101, we break down the economy, inflation, markets, and financial news in a simple way. Remember, this is Economics 101, your number one source for everything econ. I'll see you on the next video. Thank you.